Welcome to The Explainer, where we deconstruct the hidden forces moving the markets. Look, today was one of those days that just sent a shockwave of confusion through Wall Street, and we're going to figure out exactly what happened. All right, let's just jump right in, because today the market basically threw out the rulebook. We got a shockingly hot inflation report, and what happened? The very bedrock of our financial system, long-term government interest rates, did the exact opposite of what everybody, and I mean everybody, expected. We're going to find out why. So this is the big mystery we have to solve. Economics 101 is crystal clear on this. When inflation runs hot, interest rates are supposed to go up. It's simple, right? Your money's going to be worth less tomorrow, so you demand a higher return to lend it out today. But not today. Today, that fundamental law of finance just completely shattered. What the textbooks say should have happened is the polar opposite of what actually went down. So let's start with our first clue in this whole mess, the inflation data itself. Because this wasn't just some boring report. Oh no, this thing sounded a terrifying economic alarm, one that's been kind of dormant for decades. You see, the market isn't just worried about plain old inflation anymore. It's now whispering about the dreaded S word, stagflation. And that is the absolute nightmare scenario for an economy. It's where growth just grinds to a halt, but prices keep ripping higher. It squeezes everybody, consumers and businesses from both sides. It's a trap. Now here's where it gets really interesting. If you look under the hood of that inflation report, the whole shock came almost entirely from the services sector. We're talking about things like rent, healthcare, wages, the really sticky stuff that's hard to bring down. It's not like the price of a TV, which can drop easily. Meanwhile, the price of actual physical goods, it fell. This isn't a sign of a booming economy, folks. This is a classic sign of cost-push inflation, where costs are just getting passed on even as the economy slows down. And, well, this data just completely tied the Federal Reserve's hands. Just look at this. The chances of a rate cut in May, according to the market's own bets, just collapsed. It went from a pretty sure thing at 65% all the way down to a pipe dream at 15%. So any hope that the Fed was going to ride to the rescue anytime soon, yeah, that's officially off the table. But hold on. Sticky inflation and a handcuffed Fed still don't explain why long-term rates went down. To get that piece of the puzzle, we have to look past the headlines to a much, much darker fear that's brewing just beneath the surface. It's like a ghost from the last great financial crisis. Turns out, the market isn't just afraid of inflation, it is absolutely terrified of a credit crisis. And nobody captured that fear better than JP Morgan's CEO, Jamie Dimon. What an image, right? Cockroaches? He's basically warning that the little problems we're starting to see in private credit are just the tip of a very, very dangerous iceberg. So here it is, the crucial point. That plunge in interest rates today, it wasn't a good sign. It wasn't a vote of confidence. It was a classic flight to safety. It was a panic move. Investors were dumping risk and piling into the safety of government bonds because they're scared of a potential meltdown in this massive, unregulated shadow banking system. This is a whole world of lending that happens outside the normal rules, and it's a huge blind spot. And this is why everyone is so spooked. The market is seeing a chilling parallel to the past. It's not exactly the same, but look, the recent collapse of a UK firm, big private credit players cutting their payouts, it just feels eerily similar to those first tremors we felt back in 2007. Right before the subprime mortgage crisis nearly took down the entire global economy. As they say, history might not repeat itself, but it sure does seem to rhyme. So what happens when these two giant fears, stagflation and a credit crisis, collide? Well, you get what we saw today, a massive, panicked rotation across the entire stock market. A truly violent reassessment of what's actually valuable in this new age of doubt. And the trigger for this was just stunning. For months, all we've heard about is the AI rally, this idea that AI would create this amazing new era of growth. But then, Jack Dorsey's company, Block, announces it's going to replace 40% of its staff with AI. And just like that, poof, the market's biggest hope instantly flipped from a dream of infinite growth to a dystopian fear that AI is just going to destroy jobs and crush the consumer. Talk about a narrative shift. And the market's reaction was a mad dash for the exits. We saw this violent capital flight away from intangible assets, things built on future promises like software, finance, even the AI leaders themselves. And where did that money go? It ran to tangible assets, stuff you can physically touch. We're talking real hardware, essential goods people have to buy. And of course, the ultimate physical asset, gold. So investors just savagely dumped companies like Duolingo, which are all about software and the promise of what's to come. And they fled into companies like Dell, which makes the actual physical hardware we need right now, and staples like Walmart, selling the stuff people need no matter what the economy is doing. Okay, so what in the world does this all mean for you as an investor? What's the new playbook for navigating this age of doubt where it feels like all the old rules have just been thrown out the window? Well, first things first, this probably isn't just a one-day freakout. It feels more like the start of a whole new market environment. The baseline assumption, or what we call the base case, has now pretty much flipped to bearish. And these are the key signals to watch that would confirm that this downtrend is for real. And then there's the black swan, the risk that no one's really talking about. It's this toxic cocktail of the two biggest fears we've discussed. The nightmare scenario is this. AI starts causing mass layoffs in high-paying white-collar jobs. That crushes consumer spending, which then triggers a tidal wave of defaults in that already shaky, over-leveraged shadow banking system. One crisis feeding the other. All right, let's pull all these threads together. It's time to summarize this whole deep dive with a final verdict and tell you the one thing you absolutely have to watch next. So, look, the bottom line is our verdict for today is clearly bearish. It's a trifecta of problems hitting all at once. You've got stagflationary data, you've got a brewing credit crisis that has echoes of 2008, and you've got a total collapse in the market's favorite growth story, AI. That's a tough combo. The single most important piece of data to watch from here on out is the upcoming jobs report. Honestly, it's become the key that's going to unlock the market's next big move. And here's the billion-dollar question. For a while, bad news on the economy was good news for the market because it meant the Fed might cut rates. But now, if we get a weak jobs number, will the market still see it as a good thing? Or will it be seen as the final proof that we're heading into a nasty AI-driven recession where bad news is just, well, bad news? And that really leaves us with this final critical thought for today. The old playbook is broken. When you have the twin fears of inflation and a credit collapse in the driver's seat, the market is sending a very clear signal. Sell the fantasy of tomorrow and run to the fortress of tangible value today.
Thanks for joining us for The Explainer.